She had $31,000 sitting in her checking account, enough to write a check for the whole car. The dealer offered to cut $1,400 off the out, the door price if she financed instead. So she thought, take the loan, pay it off Monday, pocket the spread. Clean win. Except there's a clause buried in that contract that could claw back every dollar she thought she'd saved, and most buyers never see it coming. Hey Profiteer, Eric here. Welcome back to Real Money Stories. This one comes from the Personal Finance subreddit. Let me read it to you in their own words. I have enough money to buy the car I'm interested in outright, but I'm wondering if I finance it to get a better price, can I pay off the loan immediately? If so, are there any fees or penalties for doing that? Also, would paying it off right away have any negatively impact on my credit score? So what the original poster is really asking is, can you play the dealer financing game on your own terms? And what does it actually cost you if you try? Okay, first thing I want to say, reading this is a genuinely smart question. A lot of people just hand over cash without thinking through the comparison, or they finance without reading a word of the contract. The original poster is doing neither. They have cash in hand, they're thinking it through before signing anything, and they're asking about the hidden catches. That's exactly the right order of operations. I've been writing about personal finance for over a decade, and the thing most articles get wrong about dealer financing is that it treats the car price and the loan as one transaction. They're not. They're two separate negotiations happening at the same time, and the dealer is usually better at both of them than the buyer is. Once you understand that, this question starts to make a lot more sense. Let me walk through each of the three questions the original poster is asking, because they each deserve an honest answer. First, can you finance and then immediately pay off the loan? Legally, in most cases, yes. Nothing stops you from writing a check to the lender the day after you drive off the lot. But before we declare this a clean strategy, here's what's actually going on under the hood. When a dealer arranges your financing through a partner lender, they often earn what's called a dealer reserve. It's essentially a cut of the interest you'd pay over the life of the loan. If the lender's buy rate is 4%, and the dealer marks it up to 6%, the dealer pockets the difference. So when a dealer offers you a lower sale price in exchange for financing through them, they're not being generous. They're calculating that the back-end income from your loan is worth more than what they're giving up on the sticker. It's math, not goodwill. The strategy the original poster is describing, financing to capture that lower price, and then paying off the loan right away, is something informed car buyers do. And when it works, it genuinely saves money. But here's where it gets complicated. Many dealer financing agreements include what's called a chargeback period. Sometimes you'll see it listed as a minimum loan duration requirement. This is typically somewhere between 60 and 90 days, though some contracts stretch it to 6 months. The clause exists to protect the dealer's finance reserve. If you pay off the loan before that window closes, the dealer loses their back-end income on the deal. And in some contracts, they can claw back that amount by adding it onto the purchase price after the sale. That's not hypothetical, it does happen. So before signing anything, read the financing contract carefully. Look specifically for the words prepayment penalty, chargeback, or minimum finance period. Manufacturer-backed loan programs, the kind that come directly from a carmaker's captive finance arm, often have friendlier terms than third-party lenders arranged by the dealer. But you still have to check. And on a purchase this size, I'd say talk to a qualified financial advisor or a consumer attorney about your specific situation before committing to this approach. Just a friendly reminder that this episode is for entertainment and education only and should not be considered financial or legal advice. Second question, fees and penalties from the lender. This is separate from the dealer chargeback issue. Some auto loans, particularly from smaller lenders or subprime finance companies, carry prepayment penalties built directly into the loan agreement. Most major banks and credit unions don't charge them on auto loans, but most isn't all. The document to check is the loan agreement itself, specifically the section on payoff procedures. It will tell you exactly what you owe if you pay early. One other thing worth understanding, some auto loans use a method called the rule of 78 to calculate interest. Under that structure, interest is front-loaded, meaning more of it is due in the early months of the loan. If you pay off early under the rule of 78, you don't save as much as you'd expect compared to a simple interest loan, It's less common now, but it's worth confirming which method your loan uses before assuming early payoff is a clean win. Third question, credit score impact. This is the one that tends to generate the most anxiety, and it's also the one where the reality is more manageable than people fear. When you apply for an auto loan, the lender pulls your credit. That's a hard inquiry, and it typically drops your score by about 5 to 10 points, temporary, usually gone within a year. On its own, not a significant concern. Opening the loan also creates a new credit account, which lowers your average age of accounts. Your credit age is part of the scoring calculation, so this can nudge the number down a bit, also temporary. Now here's the part that surprises most people. Paying off the loan quickly doesn't hurt you the way a missed payment or a collection would. The account shows up on your credit report as paid in full, in good standing. That's a positive installment trade line. It's not as beneficial as keeping the account open for several years would be, but it doesn't create a scar on your report. The one scenario where the credit hit matters more is if you have a major credit application coming up in the next 6 to 12 months. A mortgage, a business loan. In that case, the hard inquiry and the new account could matter a little at the margin, worth factoring in if that applies to you. So here's what I'd probably do in the original poster's shoes. Before agreeing to finance, ask the dealer to give you both numbers in writing. Cash price, finance price, calculate the actual difference. Sometimes the discount for financing is smaller than it sounds once you factor in the mechanics. If the numbers favor financing, read the contract before you sign it, not after. Look for chargeback periods, prepayment penalties, and any reference to the rule of 78s. If the contract is clean, proceed. Once you've financed and want to pay it off, call the lender directly and ask for the exact payoff amount. Don't just send in what you think you owe. Interest accrues daily on simple interest loans, so the number is a moving target. Get the exact figure, pay it, and get written confirmation that the loan is closed. And don't let the credit score piece derail an otherwise sound decision. A few points for a few months is not worth walking away from real savings on the car price, assuming the contract terms allow for it. The specific question here was about a car purchase with cash already in hand, but the principle that lives underneath it applies to almost any large purchase involving financing. Every transaction that comes with a financing offer has two negotiations inside it: the price of the thing and the cost of the money. Understanding both separately puts you in control of a deal where the other side is almost always more prepared than you are going in. Knowing the mechanics changes that. If you found this helpful, share it with someone dealing with the same thing. Until next time, stay profitable.